Hey, so you made it to part three. So in the previous first two, I talked about what I thought about South Africa, their rules and regulations and everything. And I guess this is the part that everybody's kind of waiting for, that I kind of stalled for. There is a reason for that. When I do stuff, I don't. Sometimes it's just projected so far in the future that like I personally don't like releasing it because everybody just has this urgency, or like this sense of urgency, to where they want to get it now because they want to get into the best price possible. They think it's going to take off. They think they're going to miss out and stuff like that. So basically, I'm releasing this closer to the day of when I'm kind of getting in, and it's not indicative of when you should get in, but like I could be completely wrong. I just want to preface that first, like that you can and probably will lose all your money just even trying to look at these trades and stuff like that. So, you know, just I would more advocate you being a sideline observer and not taking any skin in the game, despite all of what I like say and everything. You have to make that decision yourself, and then see if it's sound. You also have to assess some of the risks as well, because there are a lot of risks to trading, and there are a lot of unseen factors that kind of just jump at you, and they don't give you any warning. It just sometimes just happens. That's just the way the game's played. And sticking with what Tom Nash does, and basically kind of giving you straight to the point answers, is that down below are the companies that I'm looking at. And originally I phased all of them out, and I still have phased all of them out because I guess I don't know. It's just for me, like when I look at a new market, yeah, I want to dive in there too, but I just don't feel comfortable, especially if I do have the option to play something in North America, because I can actually look through their filings. I understand how the system's played and everything. Not going to display it on screen right here because I'm not going to make it that easy, but just take a look down below. I'll probably just write down a quick overview of the companies I looked at, why I'm not trading them, and the company or the thing I'm actually going to talk about is a certain ETF that kind of essentially, I think it flew under everybody's radar. I discounted it because I didn't like it, but yeah, it's called SPPP. So yeah, I'm going to be looking at that and diving mostly into that, but I will first glance through all the other companies and they're just really quick cursory glances. There are good things and bad things about them. Yeah, so I hope you enjoy. So to begin, I usually look at some of the risks, things that happened in the past as well, and I take that in consideration as well. Whether I see them coming up again, for something like this, I see it as a probability because of events that have happened in the world, and just this whole like virus situation and everything, and lockdown and all that sort of stuff. Like it's just it presents a factor for this to happen, and history does repeat itself from time to time, and this could be a reality. But essentially, I did look on their on the Wikipedia for South Africa, and it did mention something about trade unions. And I'm just going to go through this really quickly. So 2007, unions representing the public sector workers went on strike. So public sector does include the miners, because they're basically half owned by the state as well as private companies. So not like partnerships, but like companies out there. There are some that are a hybrid, but whatever. Like I'm not going to dive too much into that. But since 2007, public sector workers went on strike, demanding pay raises significantly above inflation, in a practice that some experts argue is suppressing job growth, harming millions of South Africans who are out of a job. Usually you don't want to see that, because you want to see that continued growth where they're having like more jobs than people. It gives them great options, and it's just a whole slew of good things. Like you can look at the previous video to get a good example of it. Now, in August and September of 2010, South African unions organized a crippling 4-week national strike involving 1.3 million sector workers, demanding an 8% wage increase, and it ended after the government raised it by 5.2%. Had raised it from 5.2% to 7.5%. Blah blah blah. This all This raise, unfortunately, the GDP did not indicate that they could raise it, which, again, this is, I don't know, the more and more I read about unions and the stances and stuff like that, and that's something you guys kind of have to detach yourself from. Like, you could be pro-union or you could be against union and stuff like that, but there are benefits, but there are also side effects to it, and that's up to you to kind of figure out if it works to your benefit. And based on, like, if you live in Canada like I do, the unions here kind of suck, especially with your retirement fund. If I were you, I'd look up Great West Life and their performance rate and look at their MERS fees and everything. But I'll probably talk about that more later. I'm getting too sidetracked here. But essentially, they were striking because they wanted more money, and it did cause a halt to their country's already fragile GDP. And on top of that, like with the wage increase and stuff like that, that's always something to keep in mind, because it could spell a lot of things, especially if the goods of whatever they're selling. Like, obviously, if you guys have run a business, the goods of what you sell have to cover the cost of the initial cost to acquire the goods, the cost of labor, and your time, and whatever's left after that. If they're a union, health insurance, etc., a lot of sort of stuff, as well as make a profit for you. So all that has to be considered. Okay, let's see how fast I can get through this. So first one up is Anglo American PLC, AGL Mining. This is these are all on the Johannesburg Stock Exchange, by the way. So they mine copper, diamonds, iron ore, metal coal, nickel, platinum, thermal coal. They also own the De Beers Company. If you guys don't know who the De Beers family is, the De Beers Company, they're most famously known for their diamonds. At the time I was recording this, they were at 37,585 ZAR. They've since grown significantly. However, this is with a expectation that essentially, because we're in the seasonality for mining right now, it's mining, agriculture, agriculture specifically, fertilizers, and there was a third one I can't remember, but not important. So Anglo American, if you guys don't know anything about this company, which I didn't either, they have ties to the Brits, and they are one of the largest, if not the largest, miner in South Africa, just in their sheer size and amount of companies and the amount of mines they own. And one other thing I wanted to point out is that the reason why I listed these things saying copper, diamond ore, iron ore, all these things, I want to know what else they mine, because when you're excavating for stuff, right? If you're excavating just for pure iron and you come across and, like, you strike copper or platinum or something like that, right? You're not going to throw that away and say, like, oh, well, whatever, we don't mine that stuff, we just whatever, right? I like companies that, especially when they're mining, because they're going to find these other things as well, like cobalt, which is needed for a lot of solar cell stuff. They need that stuff. All of it can be used and sold, and I like it when they are able to adapt and think and do all that sort of stuff. And that's probably why Anglo American is probably one of the biggest down there, because they mine a whole slew of things. And yeah, so then the next one I looked at was also KIO, or Kumba Iron Ore. And at the time I was looking at it, it was about 48,000. It is now 60,000. Now, they only do iron ore, more specifically because, I don't know, they just specialize, whatever. But again, I didn't really find much about this one, and I just really didn't, I don't know, I just personally didn't like it. So I like it when they, like I said with Anglo, they just don't limit themselves that way. And the next one is Impala, oops, not that one. Let's see if I can find it. Yeah, here we go, Impala Platinum. Hold on. If you guys remember from the last video, there was a report coming out. So this company has ties to a Canadian company, and they mostly do platinum, but they also do palladium as well. That's something that's not really mentioned too in depth, I guess. But let's see. So they're about 1900, and they were 1400 before. Again, this is all because they're coming into seasonality. I know, if I released this before, everybody would be like, oh, but you missed out on this much profit. That's not the point. the whole point in is that like this could have just been a lucky rise, or it could be due to inflation, that sort of stuff. There's a thing to be said about patience, and you don't know if this is going to pull back in like mid-December or whatever, right? Like I'm not trying to time my entry too much to that kind of T and just regret like missing out on this thing. If you got in early, great, go ahead, but honestly that's not how I roll. You guys can figure that out on your own. Next one up is another Anglo American. This is kind of like a subsidiary company, but they're at 106,000 before they do platinum. This is their platinum division, and now it's at 130k or whatever, right? So again, I don't care. It's not how I play. It's not how I roll. And the last one is Exxaro Mining, and if I can pull it back up quickly enough. All right, so it was at let's say 11,000. They do specifically coal mining, and they jumped up to 14k. Here's the thing: I wanted to focus specifically on platinum and palladium because those markets are very weird. And if you guys remember the graph from before, they do have a historical measure of moving up, and I was trying to use the momentum of both the presidential thing, inflation, green energy, all these sort of factors to kind of lead me into my reasonings of why I wanted to get into this, get into platinum and palladium specifically. All right. I'm going to make this as a quick special mention though, but I did look at PPLT or Aberdeen or Aberdeen, whatever you stand on the fence for that, but it's a $97 stock, and there are a few things that I don't like about this, and like I'm not saying it's a terrible play and stuff like that, but there are just a few things I don't like about it, and I'll kind of dive into it a little. Now, first thing with me is that I'm always concerned about the shares and how much transaction they do, and this kind of does low transaction. It's not necessarily a bad thing, but what it tells me is that you're going to have liquidity issues, especially if you go really hard into these like really high price but low volume stocks. And you might see this to where it's 97.80 right now, but the bid might be at 97.50 or even 97.20 or even 96.95, whatever, right? And it keeps cascading through those levels because there are huge gaps in between, and that's only because some people have to try to make a market there, right? There might not be an actual buyer until like $80. You never know. So there's a lot of price risk in this type of thing, and I don't know. I just personally didn't like. I like the fact that it was very specific towards platinum, but I just didn't like the price and I didn't like the volume. However, with that said, my pick, which is, I'm gonna pull this up right now, and there are some special mentions out there too, like PALL and stuff like that, but most of them are very low volume. This one I picked is $17. The volume is shit. You will see probably gaps or spreads between 10 and 30 cents or so, probably more even, I don't really know. But in terms of risk, I would much more be comfortable taking the risk in this than in Aberdeen, because Aberdeen's already a $97 stock. If I was to plug 100 shares through both of these things, it's the difference between losing $10,000 and $2,000. So with me and risk, I'd rather just lose the $2,000 than just lose the 10,000. And I understand that most people are just be like, oh man, I'm gonna go all in on this stuff and like that. Don't. I advise you to sit on the sidelines, watch me fail, and make your own decisions based on that, because I might be wrong. I might be right like once, and everybody will think like I'm a genius and all that sort of stuff. No one thinks that. But of the times I'm wrong, I'm happy to take the L. I'm very much used to it. And with something like this, I expect there to be some jump in it because of the green initiatives that have been set in place. It's kind of, but not really, a hedge for some inflation because it is considered a precious metal and everything, but it is useful for batteries, the anodes and stuff like that that I covered previously. There are a few other medical uses and glass making and stuff like that. You can all explore that on your own time. But overall, I'm looking at SPPP as my play, and I will show you the equity clock thing. And if you guys don't know what equity clock is, John Velux, he works for Horizon ETFs and everything. Like he basically has this like little, his daily analysis are impeccable, and his monthly, weekly, and everything all top notch. You guys should check it out. It's equityclock.com. I don't get anything from this. I just think what he does is fantastic, and yeah. So typically for this thing, for SPPP, I'm playing it in somewhat of an off-season sense because, according to Velux, it's from July till September, right? Don't really pay too much attention to this hit rate, like, you know, 6 of those 6 years and the 6 times whatever was successful and all that sort of stuff. None of that matters. Especially with such a low rate of data, they want at least 10 years and then preferably 20 at the bare minimum to kind of reference back, because nothing's 100%. Now, because I'm making an off-season play, I want to see the similar behavior, which I kind of did because if you guys remember in late November and basically updated now, we did see that rise in price, and then we also saw a slight dip into December. Not like a huge pullback. It's obviously not a one-for-one comparison all the time. Like, you don't expect this market to drop like 3% just like that, right? You know, any small pullback, for me at least, will do. And now we're kind of seeing the rise back up later into past mid-December and everything, right? And that's kind of what I'm targeting. I'm targeting this rise from late December into possibly February. If I get a good chunk out in January, I'll be a happy man, because I want to avoid this possible pullback if there is one. But you guys know me. Like, I advocate, if it shoots the moon, great. Like, you know, I am all for that, but I'm not looking for a home run. I'm just looking simply to make some money based off something that I've read about, took interest in, and am theorizing a type of play for. So again, I don't guarantee anything. What you do is up to you. And yeah, that's all I can say, other than just remember, just because you're a day trader doesn't mean you have to trade every single day.